We're going to be talking about passive debt funds, and there are several reasons to do so. Firstly, SEBI has tweaked certain guidelines of where and how much can passive debt fund managers invest in. Secondly, if we will look at data in terms of performance, it's interesting to note that when it comes to passive equity funds, the outperformance versus active funds is not that much. But when it comes to passive debt funds versus active debt funds, there is a tad bit more outperformance. So then why pay that extra expense that is entailed in active fund management? And finally, of course, for fixed income funds, how does the RBI's rate decision move the needle for them? That's what we'll be discussing with Feroze Azeez, Deputy CEO of Anand Rathi Financial Services. Feroze, thank you for joining us on the Money Show this evening. And I think let's kickstart with the most complex and the most boring topic of sorts. And I promise our viewers that, once you get over this, once you understand this, we'll get on to the more exciting part, and that's eventually how you can make money. So first, I want to talk about the RBI decision. Of course, yesterday, Shaktikanta Das kept the interest rates put, did not change it. But we do know we are in this low interest rate regime. So in such a regime, how can an investor make money via fixed income funds, or how exactly does fixed income fund performance depend on, what the RBI does?
See, whatever the RBI does, it tries to maneuver the interest rate up and down depending on what kind of liquidity it so chooses to have in the system. Of course, repo rate and reverse repo rates are rates which are the rates or given in between the bank and the Reserve Bank of India. Does the life of an investor in a debt fund depend on this? The answer is a no. It depends on the 10-year government securities yield. So that's called the 10-year GSEC yield. So point one, Mubina, these whole bi-monthly monetary policy decisions don't directly impact the investor, but the 10-year GSEC yield does. That's point one. Point two, given the current circumstance, of course, the RBI governor decided not to move the interest rates lower yesterday, but it has been done 5 times this year. I think still the accommodative stance of giving assurance that it can still further go down in the future was a very positive sign. So interest rates in this country are headed lower to propel the economy. That's one thing which is a clear writing on the wall. Now comes the third step of how to make money in a situation, if that's what your opinion is. So lock in your interest rates for as long as you can, 3 years, 5 years. If you can lock in your interest rates, you would be better off than having it as a moving needle. So that's the point I would like to make, Mubina.
Okay. Now, the second point, there was some data crunching that one of our research members had done, and that was that there is a better chance of outperformance in a passive debt fund versus an active debt fund. That would not be the same for equity funds, but it is definitely the case for a debt fund. Now, we do know, Feroze, for a fact that a passive debt fund obviously will carry along with it lesser expenses because you do not have to pay the manager's fees because it's a passive fund. So based what is your opinion on that? I mean, would you recommend then that individuals should opt for a passive debt fund? What are the advantages and disadvantages of both?
I think a passive debt fund, there are 2-3 categories which are passive debt funds, because this has, as a nomenclature, not been used, Mubina. I think I'm hearing this for the first few times, where active and passive debate is largely dedicated to equity and not towards debt. So now that we are discussing debt and passive and active, FMPs are passive debt funds, accrual funds. Quite a few accrual medium-term funds are passive debt funds. In my opinion, passive is a better strategy. The small little outperformance does not motivate me to get into active management by the fund manager, because outperformance could be there, but it's minuscule. It's not worth pursuing that. In equity, outperformance has been 5, 6, 7% as well in the past. That's one thing, that's one road I would go down the path, because that's a very large corpus. Anything as little as 0.5, 0.75%, I don't think merits active management. So accrual funds and FMPs are the passive ones, I would like to call them. But having said which, if you bought an FMP, please be rest assured that your money is locked in. If it gets locked in, especially in a credit environment like we are today over the last 1 year, I would definitely not want to lock in my money. So I would take an open-ended, passively managed accrual fund. The word accrual implies that the fund manager buys the bonds and waits for time to lapse and accrues an interest rather than trading in them. So that's what an accrual fund is. So I'm still a no-no to an FMP passively managed, but an accrual fund which is passively managed has marginally lower cost, but has the liquidity which is paramount importance in the current situation, has to be taken into account.
Okay, so you've used a lot of important words, Feroze, and at the end of the day, our viewers will be like, okay, so give us some examples. So, Feroze, why don't you share some options that viewers have within that category that you mentioned?
See, I think it's important to, in debt, not buy one or two funds. See, in equity, you might start with one fund, a large cap, then a multi cap, then a mid cap. But I always suggest on the debt side, try and buy 4 or 5 funds so that your money is spread thin enough that you don't have to worry as much. So, point one, ICICI Medium Term Fund, Fund 1, Kotak Medium Term Fund, HDFC Credit Risk Fund, Franklin Dynamic Accrual Fund. All these funds largely follow a passive strategy and hold those bonds and enjoy the interest, the higher interest which currently prevails in the country. So for debt funds, Mubina, should be the minimum debt fund somebody should begin with, even if he is a small time investor or a retail investor starting out. Don't buy one fund. That's not a very good habit to do, because having 4 will automatically mean that you've given your money to maybe 100 companies. Even if a few of them go insolvent or bankrupt, you're not going to have situations like a couple of cooperative banks going bankrupt, which has actually resulted in huge losses for people who had let their savings be in one specific bank.
Okay, yeah, and point taken. We are in that sort of an environment where people are looking at even, AAA rated bonds, etc., unable to pay their debt, to mutual funds. But Feroze, you mentioned that you should have at least 4 to 5, debt funds in your portfolio. But what if, I want to save my money for retirement? I obviously have a long-term time horizon. Would you at all recommend that then those individuals have debt funds in their portfolio and they should just stick to equity funds? What should be the mix then?
See, I think retail investors have nothing to do with debt funds, in my opinion. Because if you have PPF and EPF giving you great tax efficient returns, and a credit backing of the government, I would certainly say exhaust your limits of the PPF and the EPF, voluntary contributions as well, and don't venture into debt funds unless you've exhausted those limits. For temporary parkings, of course, debt funds are relevant. Like Mubina said, this is the context of retirement. If it is a retirement, debt funds have no relevance in the retail investors kitty, because you anyways are going to be able to lock in the money for retirement. It's not going to be 2 years down the line that you will retire unless you are already 56, 57. So for retirement, don't use debt funds. For short-term parkings or even 1, 2, 3 year parkings, use debt funds. Otherwise, use the most stable, tax-efficient, government-backed saving schemes, which can give you, especially the PPF and EPF, where tax efficient is just right up there.
I just want to take this opportunity to also remind our viewers that we are going to kickstart our Ask the Money Show segments. If you have any questions or queries, you could call in on 24990300. Okay, Feroze, there are certain changes as well that SEBI has actually introduced. Among them, they've essentially capped the exposure. This is, by the way, for debt ETFs. So they've capped the exposure of ETFs to a single issuer to 15%. They're very strict with the ratings as well. They want it to be investment grade and above. And of course, if there's any downgrade, then the rebalancing should be done within a certain period of time. I suppose all of this is, again, in light of the sort of fiascos we've seen with respect to, like you mentioned, certain FMPs, certain debt funds as well, where the NAV values have crashed. So while it may make a fund perhaps a bit more safer, what would you make of the return bit? Do you think this caps the return potential of these debt funds?
No, I think Mubina, these laid out rules are more or less some things which a fund manager was already following. So these rules are basically hygiene items. In normal circumstances, a fund manager is not going to be putting in more than 15% in a specific issuer. Secondly, an investment grade, anything which is an investment grade is what forms a part of 90-95% of the debt fund industry or even more. So these are good rules to put from a future perspective. Will it change the risk reward ratio of any of these funds? I doubt that because these were rules which are very broader in nature. I'm sure an asset management company which manages thousands of crores have put more stringent rules upon themselves, self-induced of course, not regulatory. So I don't see too much of a change in the risk and reward, but definitely cuts the urge of a fund manager doing something fancy and flamboyant in the future.
Okay. And finally, Feroze, before we take on board some viewer queries, I wanted to ask you about your opinion on the Bharat Bond ETF. This is the government's second tryst, I suppose, dabbling with retail investors. They did so with the Bharat 22 ETF. Now they want to do so with the bond side as well. They want to deepen the corporate bond market. I know it's too early perhaps for you to say, but do you think that's something that individual investors should look at, the Bharat Bond ETF?
I think so. Yes, absolutely. Like we were just speaking, that if you can lock in your interest rates for long periods of time, it's not a bad idea at all. Because the interest rates over the next 10 years, to my mind, the average of those interest rates is going to be lower than what you can lock in today for the subsequent 10 years. The 10-year bond on the ETF side, the Bharat ETF, is giving a return of almost close to 7.5, a little over that. So 7.5% return locked in for 10 years is something which I think is very lucrative, and not take the 3-year option. Even if my investment time frames are 5 years, I would still choose a 10-year option and choose to sell my bond 5 years later, point one. So, Mubina, to be explicit about my opinion, I would definitely vouch for the Bharat ETF, especially the 10-year option. Second is, even if your time frames are not 10 years, I would still buy the 10-year option because you're getting 1% more than the 3-year alternative. And if I wish to sell it after 5 years, I will be able to make more money in the form of higher interest, and also a certain degree of capital appreciation is what I will envisage. Of course, that's not 100% certainty, but a reasonable 90-95% chance that you will get over and above the capital which you put in. And the good part is you're not being taxed on a yearly basis. So tax efficiency in the form of capital gains is also something which is very, very lucrative. So a big thumbs up to the 10-year alternative, not the 3-year alternative. I would definitely not put my money at 6.5% for 3 years, but locking in for 7.5 for 10 years is a wonderful alternative. And especially because these are PSU companies. And I think there is certain degree of quasi government backing to these is why I would like to look at them. And there are 13-14 bonds in each of them, so it's not one single bond I'm buying. It is impossible for a retail investor to buy 13-14 bonds. So you're getting a basket of it, tax efficiency, locking in interest rates, a higher interest rate of 7.5. So that's why a thumbs up, Mubina.
Okay, so ticking all the parameters, folks, if you're wondering how you can subscribe for it, 12 December is when the NFO opens. So take your decision. 7.5 to 10-year duration is what Feroze is recommending. Okay, time for our viewer queries. And we've got our very first caller, Meena from Mumbai, joining us on the phone line. Hi, Meena. Good evening. What's your question?
Hi, good evening. My dad retired a couple of years back in 2017.
Okay.
And I have invested in money 5 lakhs each in 2 debt funds.
Okay.
First fund is the ABSL medium term plan, and the other fund is DSP credit risk fund.
Okay.
Now I had invested this money with a time horizon of about 3 to 4 years.
Okay.
But currently the issue is both these funds, because they have ILNFS and Vodafone Idea exposure, both the funds are sitting on -1% right now.
Okay, so
I just wanted to ask, if I continue for a couple of years more, will I get the return? When I invested, the YTM was 8%. So if I continue for 2 years more, what is the likely return which I'll get?
All right. Okay, so Feroze, you heard her. She's a bit perturbed because of the ILNFS fiasco and, of course, Vodafone Idea as well. Unfortunately, both of these securities are in ABSL medium term and DSP credit risk. So what would you recommend Meena do?
So Meena, for both these funds, my opinion would be different. But one thing I think you may or may not have noticed that ABSL has actually carved out Adilink, which is an SL Group company, into a separate fund and given you units which should have got credited as latest as yesterday or day before in your demat account or your folio. So ABSL might be showing negative or just at par. But apart from this, there is a carved out portion which is the bad apple into another entity. So the point is now removing ABSL doesn't make sense because it has already bifurcated the good papers with the bad papers. So if you stuck on to ABSL, but you should certainly consider exiting the DSP fund because they've still not side pocketed the bad ones. So point one. Stick to ABSL, that's my view. DSP has to be removed, especially when there's no tax incidence. And I hope you've finished the exit load period of a year and a quarter, if I'm not mistaken. If you don't have an exit load liability, you anyways don't have a tax liability for the fact that you've not made money in the DSP fund. I would certainly exit that and buy a few funds, especially like the ones, the Franklin funds, which of course have Vodafone in it, but it's already marked down, where the YTMs are as high as 10 and a half. So even if the Vodafone gets written off, you will still end up making 7.5 to 9% return over a 3-year period. So that will be my pointed recommendation, Meena.
I suppose side pocketing, Feroze, if I'm not mistaken, which a lot of the debt funds have been, doing for these, for these so-called bad debts, if you could call it that. Meena, I hope this recommendation was useful for you. Let's take on board our next query. Shankar Singh from Andhra Pradesh joining us on the phone line. Hi, Shankar. Good evening. What's your question?
Good evening, madam. Good evening, sir. Myself, Shankar Singh, age 37 years from Andhra Pradesh. Sir, I have already taken care of my debt portfolio by investing in my PPF and my company's Ultratech Provident Fund. Okay, sir. And I am investing in equity funds since the last 1 year for wealth creation, for the inflation beating returns. I am investing rupees 20,000 rupees in these 5 funds. Just I want to know that whether I can get a good return. I can expect 11% or something like that till next 23 years. My retirement is on March 2043. I am investing since November 2018. My 4 funds are Parak Long-Term Equity Fund, 4,000 rupees, Kotak Standard Multi-Cap Fund, 4,000 rupees, Mirai Asset Emerging Blue Chip Fund, 4,000 rupees, Mirai Asset Mid-Cap, 4,000 rupees, and SBI Small Cap, 4,000 rupees. Total 20,000 rupees per month. According to my increment, I will increase SIP by 10% every July. My increment is on July. And can I expect 11%? 11 to 12% minimum, and I want to accumulate 3 to 4 crores till 2043, sir. My retirement is on 2040. However, now my running portfolio is about 5% return. In this since last 1 year.
Yes.
And one another issue is that the high AUM of Kotak Standard Multi-Cap Fund, it has gone to nearly 29,000 crores.
That's right.
My SIP is running, sir. So the 3 questions are there. That is a problem.
Okay. Well, fair enough.
Kindly guide, sir.
Sure, Shankar. Glad you called in. I think, I suppose, Feroze, I don't think you'll have any problem as such with his portfolio. And I think 11% you as well have mentioned in the past is, I think, a very reasonable return to expect for, the long term, from an equity mutual fund.
Yes, Mubina, of course. So like you rightly pointed out, 11-12% kind of return over the next 20-25 years is a fair expectation. 23 years is not an unreasonable expectation because even if you look at the emerged economies, earning 8-10% dollar returns being in the US equities is today possible. So I don't see we progressing so much with the lower inflation, lower interest rate regime that we can't make double-digit returns over long periods of investing. There will be value created in equity, and if the fund managers are right, they will definitely capture a large portion of this value to be created in the market. So point one, I think your expectations are very fair, Shankar. Second point is, I am so glad that you're so specific about a retirement which is 2043. And I think that kind of foresight is, I think, what we need to invoke in most of our other viewers, which is great. Third is, I think you will have to look at your corpus. 3 to 4 crores, I don't think should be sufficient in 2043. That's going to be a small amount, which optically today looks wonderful. And the good part is, even if you consistently invested this 20,000 rupees and grew it as your age and salary in turn grew, I don't think you will be stuck at 3 4 crores. You will supersede that by a handsome margin, and you will need to, because inflation is something which is a very wild animal, which can definitely deteriorate your values substantially more than we can comprehend without an Excel sheet. So that's point two. Point three, or five funds, for whatever I could recollect. I would say there are some changes which you should make. You have two Mirai funds. You should not have two Mirai funds. You have a long-term perspective. You have a Parag Parikh fund. You have a Kotak Standard Multicap, two Mirai funds, and an SBI fund, if I recollect right. I would say both these Mirai funds, I would not be doing an SIP. I would be investing in the Mirai Large Cap Fund, where I think their capability of top-down stock picking has been and sector picking has been exhibited very well. And Parag Parikh may not be the top 10 AMCs from an equity management perspective. I think the policies, the frameworks, the analyst strength, the fund manager pedigree, all of that could be have a higher probability to be in the top 5 asset management companies. So I would not be in that. And if you are in the SBI mid cap or small cap fund, if I heard you right, go into an SBI focused equity managed by R. Srinivasan, being in the same AMC. So I think minor changes to your fund, and reviewing this and not staying on a snooze mode for 23 years, and reviewing it every couple of years to make sure that you have the most contemporary managers in your portfolio. I think you're duly bound to do that so that you can reach your retirement corpus.
And the Manish are always there to help you review that portfolio time and again. By the way, Feroze, he also had one more question on the size of the Kotak Standard Multi-Cap Fund. Should the AUM size, basically, it's ballooned significantly. Is that something that investors should keep a watch on?
I don't think at this stage you need to be worried, especially in a multi-cap fund, because the kind of space a multi-cap fund can operate is the entire market, and we are speaking of a very large market cap, and we are speaking of close to 2 trillion market cap. So 29,000 in the context of where all the fund manager can spread his canvas is very small, and especially when Kotak Standard Multi-Cap, to be more specific, has a large portion of it in the large cap companies, the top 100 companies as per market cap free float. So I don't see it as a reason. But if this same fund had an asset like a HDFC mid cap, it's a very large mid cap fund. And if that kind of sizes happen to be reached in small cap funds, I would definitely say the agility in the fund will be compromised. So Kotak Standard Multi-Cap, by the virtue of it being a multi-cap and focused on the large cap, I don't see that as a big worry. As we progress, quite a few mutual funds will touch those 50,000, 70,000 crore market cap. As long as they're large cap funds, I wouldn't be too worried about it.
Okay. All right. Well, there you have it, Shankar. I hope we've been able to answer your question. We just have time for one last query. Mr. N. Nandagopal has written into us saying that he's been investing in, I think, a total of 4 bond funds and debt funds. There's a Kotak Corporate Bond Fund, the HDFC Short-Term Debt Fund, ABSL Savings Fund, Axis Banking and PSU Debt Fund. Now he wants to add 2 more funds to this list to decrease credit risk, and he needs a lump sum amount of 10 lakh rupees. Okay, he's not mentioned when does he need it. He basically wants to know which are the 2 good debt funds. So he already has 4 and he wants to add 2 more. You were talking, Feroze, about how it's good to have at least 4 debt funds for the precise reason of diversification and to avoid the concentration risk, and of course to decrease credit risk fund. So firstly, does he need to increase it to a 6 in total? If yes, which are the 2 extra you would recommend he consider buying?
No, I'll definitely congratulate you, Mubina. I think this kind of understanding of your viewer is emerged because they would be looking at the money show and taking the right cues. How I wish every investor could think in this direction and increase the number of debt funds to reduce the impact. Of course, it's a logistical nightmare to have 8-10 debt funds over a period, but I think it's still well worth it, because credit risk is the biggest risk known to mankind, at least in my opinion, because you get it all or you mostly get get nothing. In the market risk, the market can take away 10% of your NAV, 20%, but credit risk is such a large risk that the company which gets insolvent pays back more or less nothing to its investors. So I think it's important. So you're in the right direction, Mr. Nandagopal. To add a couple of schemes, you can look at Kotak medium term, ICICI medium term, HDFC credit risk. These three funds, which are not in your portfolio, could be a good complementary part of your portfolio. If you added, I wouldn't even discourage you to go 7 funds, 4 plus 3, because it will only create a little more hassle to invest. But I think your money would be safer doing that.
All right. Well, compliments go to you as well, Feroze, for so simply explaining the basic concepts and tenets of investing to all our viewers. But with that, we're out of time. So thank you, Feroze, as always, for joining in on The Money Show. Folks, if we've not been able to take up your question, don't fret. We'll be here on Monday, Tuesday, and for weeks after that to get your questions answered.